The Wealth Equation podcast by Maurice L. Wilson reveals how to accelerate your wealth and secure more money, time, and freedom by leveraging the investment powers of real estate, entrepreneurship, the stock market, and more. Tune in as host Maurice L. Wilson, an engineer turned financial advisor, offers you a step-by-step formula to solve your wealth equation once and for all. Here's Maurice.
Hello and welcome back to the Wealth Equation podcast. I'm your host, Maurice Wilson, broadcasting to you on the day of yet another rout in the market due to our ongoing trade war. And I just want to take this time to talk about the importance of having cash in a market that is steadily tumbling down. And this is actually one of the more exciting times to be an investor, although it may feel very painful. I did a podcast about this when it was just my audio podcast episode. You can find that at the Wealth Equation. It should be in the first 10 episodes. It was an episode called the Buy Low Equation. And I kind of want to revisit that at this key moment in the market. So cash is king and how to hold steady in a tumbling market. So one of the things about a tumbling market, a bad market, a market that's going down is that we have to let go of the idea of how my account is performing like right now, right? In bull markets, you wake up every day, markets that are going up, and wow, I've made, another $1,000, another 10,000, another 100. And it just seems like it's going to grow forever. In bad markets, it's the reverse. Hey, I've lost 1,000, lost 10,000, lost 100,000. This thing's going to go down forever. Those types of markets, those bad markets, they don't come around often, but when they're here, they get our attention because it's such a departure from what we've had previously. So for the last 2 years, the market has had really good returns. We had a decline in 2022, but 2023, 2024, markets did really well. And so, hey, we're looking for another 20% gain on the markets. And we've run into a freight train. So how do we take advantage? How do we hold on to our cash? Why is cash king? So one simple rule about stock markets or investing: you make money by buying low and selling high. You don't get low prices in bull markets. You get low prices in tumbling markets. So what we want to do is, if we want to take advantage of these tumbling markets, we got to have that cash in reserve to put that money to work. Now, how do you hold on to it? First off, you've got to have a strategy about investing where you always keep a little bit of cash in your portfolio. The way we invest here at the firm, one of the biggest complaints I get from clients is, hey, what's that extra 10%, 15%, 20% in cash doing there? Why aren't we fully investing? Well, markets like this are why that cash is there. And so first off, you just want to have a strategy where cash is part of your investment portfolio. It's just part of your investment portfolio. It'll seem like a drag on returns in good years, but in years like this, those prices that you missed when you didn't have the money in the market, they're coming back around and they're even going lower. So Apple was at 260 a month ago. It's under 200 now. Nvidia was at 145 back in November. It's under 110 now. And so forth. Meta shot up, or Facebook shot up to 700, I think. It's under 5, under 6 now. And the list goes on and on and on, right? And so if you loved it at 700, right, you're really going to like it at 500. So having cash as part of your core investment strategy is the first step to having money for these tumbling markets. Now, the second thing is, I want to be careful here, knowing not necessarily when to buy, but why you're buying at certain price points. So again, going with the buy low, sell high. So what I tell people is you want to look for key price points to buy so that when the market recovers, you get a pretty good return. So what I like personally, but this isn't a recommendation, is I like to buy at three key intervals when a market is declining. Okay. 25% off, right? So think of it like this. An investment is selling at $100. So let's keep it simple. It's selling at $10, right? And it falls 25%. When it's falling to 25%, if you buy at that level, and in this particular scenario, we're just assuming the market's going to recover back to where it was before, right? So that's our primary assumption. So if you buy at that 25% off level, well, then you've already baked in a 33% return when the market recovers. So right off the bat, if you're patient, you have that cash sitting there, market drops 25%, and this can apply to the market or a particular investment you're following. A lot of these tech stocks have sold off 20 to 30% already. So people who are buying these stocks at this price point, if that stock recovers, you're looking at a 33% gain. But it gets even better. So then we look for the second price point, which is 50% off. Typically, when an investment is 50% off, a lot of times it's done falling, right? Not guaranteed, but typically it is. All right. So if you buy at 50% off, when that investment recovers, that's a double or 100% gain on your money. So every $10, 1,000, 10,000, 100,000, you put the work at that level. Should that investment recover, that's going to double that money. Now, what I like about the 50% off level is that, well, if it's already fallen 50%, a lot of the fluff, a lot of the overpriced nature of that investment, of that market, has already been wrung out. I feel really comfortable buying in at that level because, hey, how much further can it fall? Well, the answer is it can fall even further, of course. All of these investments can go to zero. So my third price point that I like, that I really get excited about, and I see some of that already in this market in certain sectors, is when it's down 75%. Now, when it's down 75%, we're talking a four-fold return on that money. So what I like about things that are priced at the 50 and 75% off level is, well, if I'm getting a double or if I'm getting a four-fold return, well, guess what? I can invest a little bit less of my cash at those levels and get more bang for my buck. So let's roll it back. Let's say you got a $100,000 portfolio. 20,000 of that 100,000 is always in cash in the bull markets, and we get this bad market, right? And some of these investments you've really been looking to get into are finally starting to come back to earth, right? So now you take that 20,000 and maybe you put 5,000 to work at that 50% off level, knowing that, hey, this thing is going to give me another 5,000. It's going to double from there. So that's a 5% return for the portfolio. You still got 15,000 in cash. So as the rest of your portfolio is going down in value, you're still holding on to 15% of your cash. You feel pretty good at 15,000, right? Then if we reach that 75% off level, well, you can put another 5,000 to work, right? And should that market recover, now that 5,000 is going to turn into 20,000. So just by taking half of my 20,000, I've created $25,000, a 25% return for my portfolio using 50% of my cash, right? So I still hold on to a lot of my cash in case the market just really gets lower. But because I'm buying so low, I can put fractions of it to work and expect a bigger return on the recovery. And all of this is just we're assuming that the market's going to recover back to what it was before, right? So we aren't guaranteeing it, but it's an assumption. And that's typically how bear markets work, right? You have your decline, your bottom, and then you recover back to where you were before and then go higher. So when you know that the game in a bear market is that you're looking for these really discounted prices, it gives you a bit of sanity and clarity as you're watching the rest of your portfolio just take it on the head, because nobody can really predict when to get in and out of the market. So there's a portion of your portfolio that's just going to get beat up, right? But if you're in sound investments or if you're in things like index funds and whatnot, as the market recovers, that part of your portfolio is going to come back. But what did you get for that round trip here, here, and here, right? Well, if you got that cash and you're buying at those three key intervals, when that market recovers, you're going to have something to show for it, right? And so that's why it's important to have that cash as part of your core investment strategy going through these bull markets and rolling into these bear markets. because when the market recovers, everybody's going to wish they had bought at a certain price point. Everybody's going to wish they were a little more braver or that they hadn't sold, right? And so having cash as part of your core strategy going in is going to be key. Now, Maurice, what if I don't have cash already? Okay. All right. Um, this is where you can sit down with us. There's a way we can restructure your portfolio. So anybody that follows sports, sometimes they'll have a key player restructure their contract, right? Say, hey, we need you to restructure your contract so we can sign some more talent. That player is still going to get paid, but they're going to restructure how that contract works to free up more cash. We can do something like that, and we can show you how to do it for your portfolio. That's one of the exciting things about where we are in 2025 is that there are all these tools that are available to literally help you get more out of how your portfolio is invested. So if you don't have the cash right now, I invite you to give us a call, 704-327-3189. Hit me up on email, maurice@wilsonwealth.com. Let me sit down with you and kind of show you how to restructure your portfolio to get some of that cash out. A lot of you have cash inside of these target date funds. A lot of you have cash inside of your index funds. So let's talk about how we can get that cash out and set it aside for a buy low strategy. So it's not too late if you've entered this market and you didn't have cash to start and you're like, Maurice, what do I do now? There's some things we can do to take advantage of those key buying points. So let's talk about what this looks like in real life. So my favorite example of something like this is going to be Amazon back in 1999, going into that bear market, that .com just bear market that knocked 50 to 55% in the market decline 50 to 55%. So Amazon was flying high. Believe it or not, Amazon had a nearly 1,000% gain in 1998, I believe. And then the next year, it fell down 80+%. Okay. Now, we already know anybody that bought during that decline on Amazon is sitting on a lot of money today, right? And so that's a perfect example of here's a stock that was flying high, kind of like Nvidia, kind of like Apple, Meta, Palantir, all these stocks that were flying high up until November. Bear market comes, knocks them down. They're declared dead. And anybody that knew when to buy in terms of the price points had that cash to buy. Anybody that did that with Amazon back in 1999, that was the lowest price point for Amazon over the next 25 years. It never saw those prices again, right? And as they say in real estate, the price is your profit, right? So the lowest you can buy, the profit is built in. This happened, of course, with Bank of America during the Great Recession. Bank of America stock fell from, I believe, $50 in 2007 to about $350 in 2009. Bank of America, I think, is trading at between 25 and 30 now, and that's after it's fallen. So even to this day, it's still nearly 10 times higher than it was back in that bear market. And that's what you're going to find. So a lot of people, they try not to open their statements. They try to hide from a bad market. You want to get excited in a bad market because you're always assuming that the market's going to recover. Why are you assuming that the market's going to recover? Because you assumed the market was going to go higher when you invested in the first place. Could there be a situation where the market never recovers? Sure, but if that's the case, there are a lot of other things going on because that means that companies are no longer having earnings. That means that the economic cycle has somehow been destroyed. And you've got a whole host of other problems that don't have anything to do with money. So that's like your doomsday scenario. And we all know how doomsday scenario predictions have worked out in the past. They have never come true, right? So you're assuming that this market is going to recover. So what you want to do is, how do I take advantage? How do I take advantage of this tumbling market? You don't have to be incredibly smart. You just have to be incredibly patient, right? You're looking for 3 key buying points in the market, right? And you can always play with these and make them your own. You can have 6 key buying points. The thing is, you want to know going in why I'm buying here. And the reason why is you're assuming on the recovery, you're going to get a certain return, right? So if you buy 25% off, 33% return. 50% off, a double. 75% off, like when Amazon went down 80% in 1999, well, that you're gonna get a fourfold return on that money. And when it's at those levels, and like I said before, I've seen some things that are at those levels right now that's got me really excited. I'm patiently going into it. I'm happy to share those with you. That's where you really do well coming out of the storm, right? The storm is going to eventually end. Don't know when. Bear markets can typically last, I think, 18 months or so. And so just buckle in, buckle down. But be ready to take advantage of those key buying points. It doesn't mean the market won't go lower after you buy, but it does mean you're putting your money to work at key levels for when the recovery happens. Again, my name is Maurice Wilson. You can find me at www.wilsonwealth.com. You can email me at maurice@wilsonwealth.com. You can sign up for our newsletter. And of course, you can reach me at 704-327-3189. We're doing this every Wednesday, Wealth Wednesdays here at Wilson Wealth. Please visit the site for other content. Again, no guarantee of future performance. No guarantees are made here. This is meant to be educational only. Please sit down with your advisor or a Wilson Wealth advisor before acting on any of this information. Thank you for joining me this evening. Looking forward to seeing you next week. Have a great week.
It is a pleasure to have you join us for this episode of The Wealth Equation. Be sure to visit wilsonwealth.com for more information about building wealth. We look forward to helping you next time on The Wealth Equation.